Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now I'm starting unit number 3 in the subject Financial Decision Making 2. Already 2 units I have completed. Unit number 1 CVP analysis. There I have explained the complete topic. We have done so many problems on CVP analysis. Second unit completely theoretical, that is pricing decisions. Various topics we have covered in unit number 2. Now unit number 3 is concerned with risk management. So the topics I'm going to cover up in this unit are the meaning of the term risk, enterprise risk, and what are the different types of risks, risk identification and assessment, risk mitigation strategies, and managing the risk. These are the complete topics in unit number 3. But in this video, I'm going to explain you the first 2 topics, that is what is the meaning of the term risk and enterprise risk. So before going ahead, take the screenshot of the points which I have written on the board, then I'll explain every point in detail. Now, first of all, what is the meaning of the term risk? The term risk has a variety of meaning depending on the context in which it is used. So normally it's a general term. In every walk of life, we use the term risk. Whenever there is uncertainty about the happening of the event, we don't know whether the event will be positive or negative. So whenever the event is uncertain, we use the word risk. That's a general meaning of the term risk. Now, at its most general level, risk is used to describe any situation where there is uncertainty about what will occur, what is the outcome of an event. So it's a general term. It is not confined only to finance or investment, or it is used generally. For example, a doctor may face the risk that the patient may be survived or the patient may die. Similarly, the accident may take place on the roads. All these are the risky situation. It's a situation in which we are not sure about the outcome. That is called risk. That's a general word. And life is obviously very risky. In life, so many things will happen which we have not assumed. We have not have any expectation of that. So many unexpected things may happen in life. So life is itself completely risky. Even the short-term future is often highly uncertain. Not only long-term. Nowadays the environment, the situation has become so dynamic that even short-term outcome also it is difficult to analyze, expect. Now we face a number of situations in our daily life, whether either to take the risk or to avoid the risk. In our personal life, in our business life, many situations will arise where the businessman has to take the decision whether we should take the risk or whether we should avoid the risk. Simple example, in my personal life, there is an opportunity to invest suppose 50,000 rupees in a company by purchasing the shares. Now I have to take the decision whether to invest the money of 50,000 in the company or should not. If I invest, I may get the dividend, I may get the return, but return is not sure. We may get return or we may not get return. That means I'm taking the risk. So in many situations, we have to take either to take the risk or to avoid the risk. Suppose I don't want to take the risk, I will leave it. I will leave the opportunity. I will not make the investment. Like this, so many situations will arise where we have to take the decision whether to undertake the risk or avoid the risk. In a formal way, the risk can be used to describe any situation in which there is uncertainty about the outcome. This is the formal meaning of the term risk. A situation in which we are not certain about the outcome of any event. Now in probability and statistics, financial management, risk, investment management, risk is often used in a more specific sense to indicate possible variability in outcomes around some expected value. This is very, very important. Now see here. In general terms, risk means a situation where there is uncertainty about the outcome of the event. That is a general term. But when we go for probability or statistics or financial management or investment management, the term risk is defined is in more specific way. What is the meaning of the term risk? It is possible variability in outcomes around the expected value. What we have expected and how much we are getting, that shows the risk. Example, in a company, we expect the return from the company at 20%. But companies sometimes give 40%, sometimes 10%, sometimes 5%, sometimes 60%. That means the actual return are very much varied from the expected return. I'm expecting 20%, but the company is giving 5, 10, 20, 30, 40, any return. That means risk is very high. So variability of actual outcome from the expected outcome, that variability is called risk from financial management, investment management point of view. Now, nature and scope of risk. I have explained the general meaning of the term risk, the general meaning and specific meaning from financial management point of view. We are not concerned with general meaning, but we are concerned more with specific meaning because we are learning financial decision making. So from finance point of view, the term risk means how the variability, actual outcome is different from the expected outcome. Now, nature and scope of risk. Risk is an integral part of the business. See here, every business will have to face the risk. Risk is an integral part of the business. There is no business without risk. Every business will have the risk. Now, it is therefore imperative that the organization learn to recognize and manage the risk. We cannot avoid the risk. Simple example, if there is a rain, can we stop the rain? No, rain, we cannot stop it. We have to protect ourselves. How to protect ourselves? By wearing a raincoat or using umbrella or any other means we can protect. We have to protect ourselves because we don't have any control on the rain. Similarly, a business, risk is always there in every business. So business must recognize this fact that we have the risk and how to manage, how to control the risk. A business will become successful only when it can be able to control and manage the risk. There are three key aspects in risk management. Now, risk management has become a very important part of every organization. Earlier, the risk was treated as bad. That means we should not take the risk. But in the present generation, if a business says we don't want to take the risk, we want to always play the safe, that means the returns will be very low. There is a direct relationship between risk and return. Higher the risk, higher the return. So if you want to earn higher return, you have to take higher risk. Higher risk does not mean we will take all the risks. No, you have to identify, you have to measure, and you have to control the risk. You have to manage the risk. Then only your return will be more. So three aspects in risk management are: first, identification of risk. A business organization must know what are the different types of risks and what are the risks involved in our business. So that is called identification of the risk. After identification, the business has to measure the risk, calculate the risk. Nowadays, different strategies are available, like VAR, value at risk, CAR, cash flow at risk. Different techniques are there to calculate the risk, that is risk assessment. Lastly, risk control or risk manage. Different methods are available for managing the risk, like a derivatives market. In derivatives market, we have forward contract, future contract, options contract, swaps. All these are the different derivatives through which a business can be able to manage, control the risk. So these are the three aspects of risk management. In the financial world, risk can be defined any event. More specific meaning of the term risk in the financial world, because we are the students of finance, financial risk decision making. So when when we are students of finance, we must think the risk from financial point of view, not from general point of view. So in examination, you should give more explanation about financial meaning, not the general meaning. Simply once you can explain the general meaning, but more you have to give the focus on specific meaning from financial point of view. So in the financial world, risk can be defined as any event or the possibility of an event which can impair the corporate earnings or cash flows over short term, medium term or long term horizon. Now concentrate on this. This is very important. So in financial world, risk means any event or the possibility of any event which will impair, which will disturb the corporate earnings, the corporate cash flows over a short-term time horizon or medium-term time horizon or long-term time horizon. So it's an event or possibility of the event which will impair, which will disturb two things: corporate earnings and corporate cash flows. That is the more specific meaning of the term risk from financial point of view. Now, in other words, the potential for future returns to vary from the expected return is risk. More specific definition. How the actual returns are varying from the expected returns. For example, company X. Company X average return is 20%. But when we see the individual returns for different years, it will go from 5%, 10%, 20%, 25, 30, 40 like that. Different returns they are giving. Sometimes 40% return, sometimes 5% return. Sometimes 20%, sometimes 30%. Like that every year fluctuating. That means there is risk in this company. Because what we expect and what we actually get are very much different. Whereas in another company, the expected return is 20%, whereas actual return are 20, 25, 22, 27, 28. Around 20% it is rotating. That means there is less risk. Because actual return are very, very near to the expected return. That is called risk from financial point of view. Now, if the returns could be guaranteed under all circumstances, there will be no risk management. Suppose, if there is a guaranteed return, that means definitely we are going to get, there is no possibility of delaying or a different risk. When we are sure that definitely we are going to get, that means there is no risk at all. Example, if I'm having 1 lakh rupees, I want to invest. 2 opportunities are available. I can invest that in a bank. The banker has agreed to give an interest rate of 15%. So if I invest 1 lakh rupees in bank, I will get 15% return interest. Whereas the same, if I invest 1 lakh rupees in a company, the company promises, normally they will give the return of 20%. But that is not sure. That is not sure. So when I invest in bank, the banker is giving the sure return of 15%. Company, they are saying we are generally giving a return of 20%, but it may vary. So in other words, there is no risk at all in bank. There is risk in the company. But the return is also high, no? The banker is giving only 15%, whereas company is giving 20% because there is risk. So if the return is guaranteed, then there is no risk. No management of risk. But in real world situation, we don't find any place where completely risk is not there. Everywhere, even banks also, we may find some amount of risk. However, such a guarantee is not possible in the real world, hence we need risk management. Now the true point is, this type of situation where there is a guaranteed return will not arise. Everywhere there is risk in one form or the other form. Then definitely we require risk management policies. Now all organizations deal with risk, though the nature and magnitude may differ from each organization. One more point. Every organization will have the risk, but the nature of risk and magnitude of risk will differ from one organization to another organization. Simple example I'll give you. Some companies are there which produce consumer goods, and some company which produces electronic goods, like mobile companies. So in which company risk is more? In consumer goods, the risk is not high. They are having the risk, but the nature of risk is very low in consumer goods industry. Whereas in technology industries, when IT industry, we will face lot of risk because a lot of technological development are taking place. So the nature and magnitude of risk will differ from one organization to another organization, but risk is imperative. This is especially true for bank and financial institutions. Particularly, this risk management is very, very important for banks and financial institutions because they deal in money. They deal in money. So money is a risky affair. So dealing in money is a risky affair. So the risk management is very, very important nowadays, particularly in banks and financial institutions, because they deal in money. They create the money. It is not like that risk management only in banks and financial, other companies are also there. But comparatively, the importance of risk management is more in banks and financial institutions. Now, sources of risk. Actually, from where the risk will arise? What are the sources of risk? The risk may arise from a variety of sources and affect the value of the assets and held by the corporations. The risk may arise either internally or externally. Within the organization, risk may arise, or outside, from outside environment, risk may arise, which will impair, which will disturb the organization. Right? So the risk arises due to possibility that the actual outcome may be different from the expected outcome. That is the definition. The risk will be there when the actual outcome is completely different from the expected outcome. The government play a very important role. Their policies may not always be in accordance with the expectation. Particularly, the main risk may arise from government policies. The government will apply different policies which affects the businesses. Business have expected something and the government policy is different. Then definitely the business will get disturbed. The assets, the corporate earnings, the cash flows, all these things will be disturbed due to the policies made by the government. This is one of the source. Then some of the factors that can expose any economic activity to various risks are. So now we are going to study what are the sources from which risk will arise. The risk will arise from a number of sources. The first source is economic policies of the government. The government will make monetary policy, fiscal policy, interest rate policy, EXIM policy, import out export policies. So many different policies the government will make from time to time. From time to time the government will make so many policies. Then what will happen? The business will get affected due to the policies of the government. जी बात है, वालेकुम सलाम। आ गए आप? एक 5 मिनट में मैं नीचे उतर रहा हूँ, अभी वीडियो ले रहा हूँ, 5 मिनट में आ रहा हूँ। ठीक है। हाँ, so government, according to government policies, then the business will get affected. Consumption and saving propensities and the preference of individual consumers. The consumers' savings, the consumers' consumption policies, this will also change from time to time, and this will also affect the corporate earnings, the corporate assets. Next one is political, social, racial and ethnic issues in the country. This will also have an impact. Technological factors. The technology is not constant. The technology is changing from time to time, due to which there is a risk. Then governance of corporation and their financial performance. Ultimately, internal risk. How the corporation is being managed and how we are evaluating the financial performance of the companies. If the company is not right, not correctly, managing or governing the activities of the business, then there is a risk. So these are the different sources from which risk will arise. The next topic is enterprise risk. What do you mean by enterprise risk? First of all, enterprise risks are the risks that could cause losses, monetary and reputation, or jeopardize a company's ability to remain in business. It is the risk which will affect the business. That means it will jeopardize the business to remain in the business. the business will get affected. The business will get completely disturbed, and that type of risk is called enterprise. For example, hazards like natural disasters and property damage. If any natural calamity arises, just like a cyclone or flood, like that, if these things happen, then definitely the business will get affected. Similarly, financial risk like asset security and currency risk. Financial risk regarding finance, how we are using the finance. If there is a cash shortage, that will also affect the business. Next one is strategic risk like business competition and trends in the market. Then operational risk like customer satisfaction, brand integrity, reputation, producers, products and failures. Enterprise risk. So these are the different types of enterprise risk. So the enterprise will get affected due to hazards, due to financial problems, due to competition, due to operational problems. All these will arise within the organization. Now, enterprise risk management, it is called ERM, helps to protect companies from any sudden threat or loss. Enterprise risk management will protect the company from sudden threat or sudden loss. The 8 components of ERM. For enterprise risk management, totally we have 8 components. The first component, organization's code of conduct. The risk can be reduced, the enterprise risk can be reduced if the company is having a good code of conduct. Everything is formally structured. Everybody knows what are the rules and responsibilities. If the code of conduct are followed, then definitely the risk will come down. Then objective setting and goal. Every organization must have a specific objective goal. So setting of objective and setting of goal will also help in reducing the enterprise risk. Identification of risk and opportunities. Every organization must identify what are the risks we have, what are the threats we have to our organization. Next, risk assessment and its categorization. So beforehand, the business organization has to categorize what are the different types of risks and how we have to assess the risk. Next one is risk response and mitigation. The business must try to minimize the severity of the risk. That is called mitigation. So if risk happens, what is the response we have to give? How to mitigate the risk loss through risk? Checks and balances. Checklist should be prepared, and every time we have to check whether this risk assessment had been done or not, whether mitigation strategies had been adopted or not. Then information and communication system. If there is good information and communication system in the business, then definitely enterprise risk will come down. Then monitoring and call to action. Time to time, monitoring all the risk, strategies, whether implemented or not, and call to action. So these are the 8 components of enterprise risk management. So enterprise risk management, ERM is a framework for managing organizational risk. So actually ERM is completely a framework, a process in order to manage the organizational or enterprise risk. Organization risk is a broad term. It can encompass concerns ranging from ensuring employee safety and securing sensitive data to meeting statutory regulation and stopping financial frauds. It's a very wide concept. Enterprise risk management is a very wide concept. It includes so many things like safety of the employees, complying with the regulations, and preventing the frauds that may happen in the business. The risk is uncertainty that might result in negative outcome or an opportunity. The risk, we should not think that always risk will be negative. Sometimes we'll get the opportunities. Then ERM is a disciplined process to identify, assess, respond and report. The last paragraph is very important. ERM is a disciplined process. So this enterprise risk management is a complete process, and it is a disciplined process to identify, assess, respond and report on key risk opportunities with the objective of advancing the organization's mission. In order to advance the organization's mission, we have to make a process regarding identifying, regarding assessing, responding to the risk factors. So in this video, I have explained you about the meaning of the term risk and enterprise risk. Inshallah, in the next video, I'll discuss about the types of risks.